Hello, Business 630 Corporate Finance students. This is Professor Hassey, and this is the week #1 update video for our online corporate finance class for this summer, 2022. I'm a little bit late this weekend. Been running into some computer problems. So today is Sunday, June 12th. You have a discussion post due this evening. By midnight. Tell us a little about yourself and pick a company that you'd like to track during the course of our 8 weeks. So please make sure you do that before the end of the day. This is just, again, a update video on making sure you have taken a look at our course at the Blackboard and getting up to speed on today, risk and return in the markets, our first week's topic. So let's begin. One of the key elements of corporate finance that we'll be studying this summer is making sure that we maximize the value of our company. That's the goal of finance, to maximize the value, taking investors' investments, capital, the borrowing of money, profits, investing them in assets that will grow the company and produce more return and more growth so you can stay competitive in your markets. Sometimes that's not easy. During a pandemic, during an inflation, during times of social or political instability. So guess what? That's why George Washington here in our slide has got his hands on his head saying, geez, all these three things are going on now. Makes it very difficult and stressful to manage a corporate department. Corporate finance is important to management because the knowledge of capital budgeting, capital structure, and working capital provides for effective decision-making if the corporation is to maximize profits and stay competitive for future success. In other words, managing the risk and return of the capital being given to your business. Maximizing that return. How do you maximize return? By selecting assets that are going to prove a viable return over time. By setting a capital structure of a combination of debt and equity to financially run your business. And the management of working capital, short-term management of cash flows, short-term debt. All these provide for effective return at minimum risk for a company. The 3 investment principles to maximize this return. The investment principle. You want to earn a return over those assets that are greater than the cost it took to get those assets. Example, I go to a bank and they give me a loan for $1 million. It's due in 3 years. The interest rate on that loan is 6%. I take that $1 million and I invest it in a piece of equipment. That piece of equipment is going to generate a return over those 3 years of only 4%. That's not how you maximize value. You want to invest that $1 million in an asset that's going to generate much more than a 6% return than the cost. That's the investment principle. The financing decision is, where did you get that $1 million? Did it come from debt? In this example, it did. Or did you get it from equity, public or private equity? Did you have an investor? Did you have stockholders? How did you obtain that capital of $1 million? And where you obtained it drives the cost of that capital. Equity is more expensive than debt. But equity's return can be postponed, where debt's returned has to be paid or you go in default. 2 different types of risks there. And then the dividend decision. How do you return that capital to the investors? Well, in debt, you got to pay it, interest and principal. But in equity, you don't have to pay that return much over time, especially if you can take some of those profits and reinvest it back into the company, which will also probably add to the value of the company in the stock market. The dividend decision. And that gives us to one of the key principles of finance, understanding risk and return. And one of the keys that are talked about in chapter 6, and probably you already know them from other study that you've had in your undergraduate years, it's called the capital asset pricing model. How to determine the risk and required return of an investment. And it's very simply this equation: the risk-free rate plus the market premium times the beta or risk of that particular stock or equity. Market premium is defined as the market rate of return in the equity market minus the risk-free rate. So let's take a look at Apple Computer. Let's say Apple Computer, let's say the risk-free rate in this example is 1.62%. In fact, now in today's world, it's closer to 3%. The market return currently is 10% minus that risk-free rate, so our market premium is 8.38%. Apple's beta or standard deviation risk analysis is 1.22. Remember, beta is a comparison of that particular company, in this case Apple, to the overall return of the market. The higher the beta, the greater the deviation from the market return, thus the greater the risk of that particular company. Zero beta is the risk-free interest rate, no risk at all. 1.0 is the beta for the market. So beta for Apple is 1.22, thus a little riskier than the average market. Put all that together into the equation, you get 11.84%. In other words, based on today's markets in this example, and the risk of Apple in the market, you as an investor should get approximately 11.84% return from that Apple stock in the next year to offset that risk of investment. Every company does this on a quarterly basis to determine their beta and to determine their expected or required return on their stock. This is an example of the cost of equity. Apple's cost of equity is 11.84%. If they can't meet that 11.84% in their asset return, they're not going to sell much stock, or the stock price is not going to grow. The capital asset pricing model, one of the key definitions of our first week. Because the capital asset pricing model proves as a cost of capital, a discount rate. That, coupled with the cash flow being generated by the company, can determine the intrinsic value or the cost or the expected return of a company. When I mean intrinsic value, I mean that's what the company should be worth based on their cost of capital and the cash flow being generated by that business. What are cash flows? Free cash flow. It's the amount of cash being distributed from the company from the operations of the business. In other words, it's the cash available after you pay all your expenses, pay your taxes, meet the working capital requirements of your business. What you have left is free cash flow, and that free cash flow generates capital to pay off existing debt and principal, to pay dividends, to buy back stock, and to invest in other non-operating assets like investments or other companies. Free cash flow is the amount of cash you have available to spend after you run your business. And that free cash flow is driven by what it costs you to generate that free cash flow. It's called a weighted average cost of capital. Whatever your capital structure is, 70% debt, 30% equity, that structure times the cost of equity and debt drives the weighted average cost of capital. We will be studying this quite a bit in this course. And then we get to the point of risk and return is how does our company stand amongst all the leading market indicators? Remember, corporate finance is not only the internal management of your cash and assets and capital of a business, it's also how your business relates to your competition, the country you do businesses in, and the market conditions. So it's very important to understand the market conditions around you. Here are the 9 key indicators that I follow of the market. Notice I give you 2019, 2020, 2021, and the current indicators as of last week. The top 3 are equity markets, the Dow Jones Industrial Index, 30 leading companies, the Standard & Poor's 500 Index, 500 companies in America, the NASDAQ, 2,500 mid-size and large-size firms. These indexes track equity performance in the market. When we are talking about the capital asset pricing model, Standard & Poor's 500 is the market indicator in that analysis. That's a beta of 1.0. The debt markets or credit markets is the 10-year United States Treasury yield. If tomorrow morning on Monday I go to my Wells Fargo branch and I have them take $1,000 out of my account to buy a 10-year United States Treasury certificate. For the next 10 years, the Treasury of the United States will give me a check for $29.55. That's the interest on that lending. At the end of 10 years, they will give me back my $1,000. $29.55 a year. Now I know what you're thinking. Boy, that's a lousy investment, but it's risk-free. There's no risk. If in 2024, United States Treasury doesn't have enough money to pay me my $29.55, they'll just print more money. Apple Computer can't print more money. Amazon can't print money. You and I can't print money. If we did, we'd be in jail. The United States government is the securest investment. Why? Because they can always pay. That's why it has a beta of 0. And that's why the interest rate is so low. But if you notice, the United States Treasury yield has gone up almost double in 6 months. That's called inflation. Money is more expensive. Because of that, the rate of borrowing money now is more expensive. Car loans, mortgages, credit cards. The United States Treasury yield is a leading benchmark of how credit is going. Money is becoming more expensive. Then the next 2 indicators are the leading commodities in the market, oil and gold. Anybody buying a gas lately? As you can see, oil has gone up significantly. Why gold? Gold is a hedge. You invest in gold when you think all the other investments are going south. It's safe, it's liquid, gold. And then finally, a key to corporate finance in 2022, because companies are doing business worldwide, globalization of economy. The 3 leading indicators of the relationship of the US dollar to the euro, to the Chinese yuan, and the Japanese yen. You track these on a month-by-month, a quarter-by-quarter, a year-by-year basis. You'll understand the conditions that your business is in and how to better manage that finances. It all evolves around maximizing the future returns of your capital. The United States $100 bill. the Chinese yuan, the euro. Wherever you're doing business, you want to maximize the investment of these dollars, yuans, euros, and maximize the return to pay back those investments, those costs, and grow your company. That's what corporate finance is all about. And to understand that concept of risk from chapter 6 and the highlights of this PowerPoint are the starting point of our studies this summer. So as you finalize the week number 1 this week, you should have a good handle on the infrastructure of our course, Blackboard, our course schedule. And again, these are all highlighted in our Blackboard. Under course information, there's our schedule of events, due dates, our syllabus. Our announcements or emails that I send you, our Zoom and YouTube links, and by week, the material you need to review and study, highlighted by my PowerPoint, which here is that PowerPoint right here. So as we head into week 2 and our discussion of the time value of money and corporate debt, we're learning about how all these forms of risk and return, the future and present value of money, and debt and equity play in making corporate finance the key ingredient in a successfully managed business. And we'll talk more about that in our week 2 video on Monday. Make sure you post your work for tonight, and I'll see you all in week 2. Adios.